Making $1,000 a month in dividends might sound tough, but it's totally doable by following 5 simple steps. First, you need to figure out how much money should be in your portfolio. Instead of thinking in terms of monthly dividends, it's easier to break it down yearly. If your goal is $1,000 a month, that adds up to $12,000 each year. To earn that with a 4% annual return, you'd need to have $300,000 invested in dividend-paying stocks. That's your target portfolio size. It's a big number, but it gives you a clear goal to aim for. Once you understand the target, the next step is figuring out how much money you can invest every month. This is crucial for staying on track. You need to decide on an amount that you can comfortably commit to and contribute it consistently. Even skipping just 1 month can set you back and make it harder to reach your goals on time. Building wealth through dividend investing is all about discipline. By deciding on a set amount and sticking with it, you create a habit that supports your long-term financial goals. Regular contributions make a big difference, and consistency is one of the most important parts of this process. Sticking to your monthly investing plan helps you build your portfolio steadily over time. The sooner you start and the more consistent you are, the faster you'll reach that $300,000 target. It's not just about how much you invest, but also how regularly you do it. That's why it's important to look at your budget and choose an amount that you won't have trouble contributing every month. This habit sets the stage for everything else in your dividend investing journey. The next step in your dividend investing journey is choosing the right stocks. Not all dividend stocks are equal, so it's important to pick ones that align with your goals. Start by looking at the company's financial health. You want businesses that are making consistent profits and have no trouble covering their dividend payments. This tells you that their payouts are reliable. Also, check how long they've been paying dividends. A company with a long history of steady or growing dividends is usually more dependable and shows a strong commitment to rewarding shareholders. Another thing to consider is the industry the company operates in. Try to focus on industries that are expected to grow or remain stable over time. A strong, growing company is more likely to continue paying and even increase its dividends. Picking the right stocks involves looking at the big picture, financial strength, history of dividend payments, and future potential. All these factors work together to help you build a dividend portfolio that can deliver income steadily over time. Once you've selected your dividend stocks, it's important not to put all your money into just one or two of them. That brings us to the next important step: diversification. This simply means spreading your investments across different companies and sectors. Even the best dividend stocks can have bad years, so it's smart to avoid having all your money in one place. If one company's stock falls or its dividend is cut, having others in your portfolio can help soften the blow. Diversifying protects your investments from big losses and helps ensure your income remains steady, even when markets shift. This balance can give you peace of mind and make your portfolio more resilient. It's a strategy that smart investors use to manage risk while still working toward their financial goals. By owning a mix of reliable dividend stocks, you set yourself up for both income and growth over the long term. The final step in building your dividend income is reinvesting your dividends. Instead of cashing them out, use the money to buy more shares. This might not seem like a big deal at first, but over time, it has a powerful compounding effect. Every time you reinvest your dividends, you're increasing the number of shares you own. And more shares means more dividends in the future, which can then be reinvested again. It's a cycle that helps your portfolio grow faster and faster as time goes on. Reinvesting is like giving yourself a raise without putting in extra work. You're using money earned from your investments to grow those investments even more. The more you do this, the bigger your portfolio becomes and the closer you get to that $1,000 per month goal. This strategy is especially useful for long-term investors who want to maximize their income over time. It might take patience, but it pays off in a big way. Of course, you don't have to reinvest your dividends if you need the cash for something else. But if your main goal is to build wealth and grow your income, reinvesting is one of the most effective tools available. It's how many successful dividend investors reach their financial targets. It's simple, automatic in most brokerage accounts, and very effective. To sum it all up, making $1,000 a month in dividends starts with setting a clear investment target. You decide how much you can invest monthly, choose strong and reliable dividend stocks, Spread your money across different companies to reduce risk and reinvest your dividends to accelerate your growth. These steps, followed with consistency and patience, can help you achieve your income goals and build lasting wealth through dividend investing. Thanks for watching Investing Flicks. If you found this video helpful, don't forget to like, share, and drop a comment below. For more expert insights on personal finance, investing, and wealth building, hit that subscribe button and turn on notifications so you never miss out.